Hey everyone, it's Rick, former investment banker, buy-side analyst and prop trader with 25 years in the game. Today I'm combining positioning, sentiment, and technicals to hunt for asymmetric trade setups. Welcome to Offsides Macro. Hey everyone. I had a very thoughtful, authentic conversation with a guest on the podcast this week. He's a true prop trader, not an entertainer that you get on most of these macro podcasts. And we spoke about volatility, trade setups, psychology. It was great. But before we dive into that, I want to be respectful of your time. So instead of me running through the report card and walking you guys through the deck like I normally do, I just want to highlight one quick observation that I think could be setting up for a trade over the next 1 to 2 weeks. And you'll find the charts for these in the deck if you open that up. But energy as a group, excluding natural gas, has slowly crept out of the lower quartile since the beginning of June and has now entered into the upper quartile. It's officially offsides long if you just look at WTI and heating oil. And we learned late this week that Saudi Arabia is asking companies that OPEC uses for independent analysis of oil production levels to submit a lower figure for the kingdom's output numbers. And they want them to use actual delivered versus pulled from the ground. And it looks like they're trying to manipulate how the oil output is counted so that they can hide overproduction. So I think that's reasonably well known at this point. The CTAs now are long across the board. They were long WTI and heating oil, and it looks like they just recently flipped long RBOB. And then we also have whiffs of Trump possibly putting further sanctions on Russia. And I want everybody to just be aware of this for next week and sort of memory bank where the current energy positioning is for a possible sell the news trade. As you know, this worked really well after Iran was obliterated. Guys, I have a really great guest this week. I'm thankful for him joining us. We found each other, I think, on Substack. He writes under the handle Free Dominion and Vixed Signals on X. I'll link those handles in the show notes. He joined my Discord, and he's always posting very interesting commentary on volatility. Tony Dundas-Luca, welcome to Offsides Macro.
Thanks a lot, Rick. It's good to be here.
Before we dive in, just give us the quick elevator pitch on your background, how, when, and why you got into trading, and then we'll take a deeper dive.
Yeah, sure. So it was not a direct route. My background academically, I studied economics and finance and entrepreneurship. So I had some exposure to the finance world, the economics world during college. I did, my financial economics courses. I think we, covered some options and equities and whatnot, but it wasn't a career path that I really knew anyone who had headed off down. When I got to school, there was certainly a lot of folks. I'm to school in Boston. I'm from Massachusetts, and there was plenty of guys from and gals from New York, Connecticut, New Jersey who had their eyes set on Wall Street. I did not. So when it was during college, I got some exposure to things there, but ultimately decided to go the route of real estate. And I worked in real estate development for the first 5 years of my career after I left college. And a few years into that, I realized it wasn't going to be what I did the rest of my life. I had this inkling, this desire to go out on my own and run my own business. I had worked in restaurants throughout my childhood, through high school and college. And I wrote a couple different business plans while I was trying to figure out what I wanted to do after real estate. And for whatever reason, I kept coming back to restaurants. And when I was 27, I took a chunk of my money, borrowed a little bit more from friends and family, and bought a restaurant that was about 6 months old in Washington, D.C. That kicked off the next 10 years of my career where I owned and operated restaurants. And during that time, I was also kind of revisiting markets in different ways. For a couple different examples, at one point I bought a bunch of Apple stock just kind of on a whim. I had like a Roth IRA, so I would do a little research and pick some stocks, and most of them would be losers. And but I remember that Apple trade because I bought this thing, forgot about it, and 5 years later, when I needed a down payment for my first condo, my investment hit 5 times, and I used that money to buy my first condo. So that was one of those like kind of powerful moments of what this, what markets can do. But I was so tied up in the restaurants that it got very little of my attention. But interesting, what ended up happening was a regular at one of the restaurants who came in and all the time, and he was a business owner. He hosted events at the restaurant all the time as well. One day he was telling me that his trainer at his gym was this like super smart he had a PhD in financial economics, I want to say. And he was a CrossFit enthusiast and a trainer, but he also was like a trader, like an independent trader on the side. And I happened to go to the same gym as this regular, and so I knew who he was talking about. I didn't know the guy was a trader, but so he ended up bringing the guy in to my restaurant for dinner a couple of times. I got to pick his brain, and this guy, his name's Dave, was very generous with just like answering questions, and there was something about it that just kind of resonated with me. And he really specialized in volatility markets, and I had no idea what that was, but it just seemed kind of interesting. And I was at the point in the restaurants where I was starting my exit, so I kind of knew that time of my life was going to be wrapping up in the next few years, and I was looking for things that I might be able to fill my time with afterwards. And so I started just poking around a little bit, and I started following Dave on Twitter, and I started trying to kind of understand and learn what he was posting about. And most of the stuff he wrote was very vague, so I didn't understand any of it for a really long time. And then as I did transition out of the restaurants and I had more time, I started studying this stuff a little bit more closely. And I went through all the normal stages that, most people in my position probably go through when you're, following all these different people on social media. I started, signing up for different services and tip sheets and this and that. And, for years, I just kind of fumbled through things. But that whole time, I just kept studying volatility, the VIX complex. Slowly over time, I figured out what Dave was writing about all those years. And every once in a while, I would shoot him an email, or I'd see him and I'd ask him a question. He was very generous, just kind of giving me answers and helping me kind of focus in on the things that mattered most. But for the most part, I really just set off on my own and just started studying things. And Dave was the first person who I'd met who, even though it wasn't his only way of making money, it was a considerable part of his career. He was the first real trader I'd met who had committed to that, and it kind of just set off a light bulb. And so it was basically just from then on out, just years and years of studying. I sold the restaurants. I had a consulting practice as well. I kept doing that. Then eventually my wife and we moved out to the West Coast because she had a really compelling job opportunity. I wound down the consulting practice, and then I went full-time trading. So I think with the volatility stuff, the way I've come to see it, what I appreciate about it is it's kind of like my little market whisperer. So I think the VIX oftentimes gets characterized as this fear index, and sure, that is certainly one way to look at it, but it's also kind of one-dimensional. Like VIX is high, the market's fearful. VIX is low, the market's not fearful. And the way Dave described it, and I think this rings more true, is that the volatility market in general is more like a thermometer. And thermometer, I mean like a thermometer you use at the doctor, that it tells you when the market's sick or it tells you when the market's healthy. And if you're just looking at the VIX, you get that kind of fear, no fear reading. But if you look at the entire volatility complex, looking at the VIX futures, term structure, if you're looking at VVIX, other measures, you get more of that multi-layered, nuanced read of the degree of health in the overall market. And to me, that was a really compelling reason to learn this as best as I could from every direction possible, because I felt that it would give me at least some edge or better understanding of where the market was at any given time. So that's really kind of the backstory of how I got drawn into the volatility world, and how that in general pulled me into markets further.
That's great. It's remarkable, right? The different forms that a mentor can take when they appear in your life.
I don't even think Dave, the guy, has any clue that he set me off down this path. Like, I really don't. Like, we talked a couple times, we emailed a couple times, but he doesn't even post on Twitter anymore. And I don't think he has any idea, but it was like this kind of crazy, just small world. A regular at my restaurant introduced me to his trainer, who happens to be kind of a VIX expert, and away I went. So anyways,
Very interesting. So let's get into the weeds a little bit. I'm an event-driven trader, and I also trade macro directional. And as you know, positioning is the main factor in my system. So Volatility, as you mentioned a little bit earlier, anything but the basics has always seemed a little bit above my pay grade. And for anybody listening, Tony writes a really fantastic weekly note on Substack, and I encourage others to read it. It's just a really great recap and dashboard for the upcoming week. And he recently posted these two really great videos that we talked about earlier in the pre-call that really captured my attention. And I want to thank you for that, because it helped me really connect the dots. And it sort of adds to what you just said about looking within the vols and how that creates actionable setups. So Tony and I are both in the game to make green, right? Not just talk entertainment. I like to troll that all the time, talking about the Fed or whatever the buzzword is for the week. So we need real signals that create asymmetric setups. So in that spirit, let's just talk about what I think is a really interesting system that you created that you call compression expansion regimes, or COMEX regimes for short. Can you just explain at a high level what you mean by that, and then we'll dive into the zeros and ones on it?
Yeah, sure. And actually, the compression expansion COMEX system is the most recent system that I've been developing. I have other trade systems outside of volatility world, and the COMEX system in particular is actually non-specific to the VIX complex. But it actually was kind of born out of my study of the VIX complex. And I think it's kind of, I'll say broadly known or broadly perceived that when you're looking at the price action of any asset, when the volatility starts to drop and the price ranges start to really compress, it can stay in that state for a very long time. But when it leaves that compressed state, sometimes, oftentimes, most times, I'm not sure, how I quantify that, but when it leaves that compressed state, it does so in a powerful way, and it moves into this expansive state. And so during my years of studying the VIX complex, I was always trying to look for ways to, whether it's quantify or qualify, what kind of regime the VIX was in. And there's various different ways that I can do that. But one way is looking at just the actual price action or the index action of the VIX itself, of the VIX futures, of the VFIC, of other measures. And so what was born out of that was this system of trying to become aware of when the volatility market, the VIX market in particular, had entered a compression regime. Because out of those compression regimes, if you move into an expansion regime, and especially with the VIX that's happening to the upside, I want to be aware of that. So I can take action to hedge my book, reduce position size, whatever it may be. And so I built a bunch of indicators and kind of broad-based systems that I keep an eye on for the VIX complex. So I was aware of when we were entering these regimes and when markets were exiting those regimes. I then found that I could take the kind of same principles and apply it to other markets. And so my approach, which is not unique, I'm not the person who developed this, but I look at a combination of the average true range, and then I look at the Bollinger Bands and the Keltner channels. And those are just two pretty simple technical indicators that can tell you to what degree price action is moving relative to a standard deviation or an average true range. And what I look for is when the Bollinger Bands move within inside the Keltner channel. And that's basically just a quick cheat code to tell you that you are now in a compression regime. And so I apply that to all of the markets I trade. And I trade most of the futures market. I do apply this to the volatility markets as well, although I don't trade them as much, especially I don't trade them the way I used to. I used to primarily be short volatility by selling VXX calls and VXY calls and VIX calls. I could get into why I don't do that anymore. But this COMEX system kind of developed out of my study of the VIX complex, and now I apply it to the other futures markets that I watch. And it's basically become a complement to my other systems I have, and I can get into more of this if you're interested, but my primary trading systems are based on horizontal kind of rectangular consolidation price patterns. I have a system that trades those ranges. I have a system that trades the breakout from those ranges. I have a system that trade trend after the breakout has happened, and I have this COMEX system that gets layered on at different parts of the consolidation, of the breakout, and of the trend. So it's just a system that kind of tucks into my other systems and helps me, identify good entries, sometimes within those systems and sometimes outside of those other systems.
So you're not necessarily trading the vol curve, but you're applying that same principle to all the instruments that you trade. Is that right?
Yeah, and I do trade the vol curve sometimes, but what I was kind of saying before is I got into the volatility trading from the short side, in that I mostly would be selling naked calls against VIX futures products. So some of the ETN, the popular ETNs. And I did well with that, but I didn't sleep well with that. And the money was good, but the sleep wasn't good. And I had enough times where I'd wake up to seeing a chunk of my P&L getting blown out because, this was kind of early. This was 2018, 2019, and then into the COVID years. And there was a lot of premium to be harvested, but there was also, you would take some pretty heavy fire at times too. And I realized that even though volatility is mean reverting and volatility does tend to trend lower, that doesn't mean you have to always trade it in that direction. And I've heard enough of, the pros, the guys and gals who, made their careers out of trading. I've heard enough of them say, don't short volatility. And I've come to really appreciate why they say that. And I'm not saying you can't do it. Plenty of people do it. And plenty of people make money out of it. I did for a while, but it just didn't align with, how I wanted trading to fit into my life. And what I realized was that I had developed these pretty detailed and accurate systems for tracking volatility so closely. And I was doing this because I was trying to develop signals that would tell me when I should no longer be short volatility, because I wanted to get out of those trades before, I took one to the back of the head. And I realized, well, I've got these great systems that tell me when to get out of being short volatility. Why don't I just flip the script? Don't be short volatility most of the time and just use the system to tell me when to get long volatility. And then even if I'm not going to get long volatility, at least it'll tell me to de-risk another part of my portfolio where there's exposure. And so, I found that, and I think portfolio managers, and I'm probably stepping outside kind of my bounds here, but, long volatility is like the greatest hedge, diversifier, balancer to a portfolio you can ask for. And yet most people don't actually utilize that as a hedge. They hedge with, a 60-40 portfolio or, CTAs or whatnot. And yet volatility is sitting there as like the best way to hedge your portfolio. And Cliff Asness and some of these other guys who specialize in the realm have all the data to back it up. And so it just, as my trading evolved and I became way more comfortable and understood much more deeply what my risk management style was, what my risk preferences are, how I wanted my trading days to evolve, what I want to do, how many hours a day I want to be staring at the screens, yada, yada, yada. I realized that being short volatility didn't align with that, but having systems that studied the volatility market closely so I would know when there were opportunities to get long volatility actually aligned with those other parts of my life, and it made more sense. So that's kind of how it came out of the study of the volatility complex for all those years.
Right. You had to go through that experiment to figure out that it didn't exactly fit your personality. You really have to match up with something that fits your personality, otherwise it definitely won't work.
Yeah, exactly.
So that lays a really great foundation. I want to zoom in on process, which is always really intriguing to me, really because it's just so human, right? And it really bakes in all of the nuances of our own psychology and risk appetite and some of those things that we just talked about. You mentioned the path towards your interest in vol, but is there something, I don't know, psychological or an intuitive that makes that more interesting to you? Like maybe it's something from your restaurant days or something else in your life?
I mean, I can speak to trading in general, and also, it's some of the specifics with the volatility stuff. So, one of the main reasons why I was drawn to trading early on, well, there's a bunch of different reasons, but it was something that I felt that I could learn to do on my own. And I don't mean I could learn the learning process I could do on my own, but then the actual implementation of what I learned I could do on my own. And that came out of burnout from having kind of at the peak, I think I had 65 or 70 different employees amongst the two restaurants. I had these, and I think you're a landlord, I'd signed these 10-year leases. I was tied to, I couldn't have been more tied down to my day job in owning these restaurants and overseeing the people. And I just got burned out on all of it. And so as I was, literally mapping out, writing out lists of the qualities that I was looking for and what I did next in my life professionally, one of the main things was not having a big staff, was not having physical locations for my businesses, was being able to enter and exit these, whatever my business was, with relative ease. Because it took me 3 years once I initiated the process of wanting to sell my restaurants. I think it took me 3 years, over 3 years, to finally get out, and it was miserable. It was absolutely miserable. I was so stressed out. Like I started having patches in my beard. I mean, it was awful. And so that that exit liquidity was important to me. And so that was one of the kind of main reasons why I was drawn to trading as just kind of more general principle. Then there was the kind of attempt to try to solve this unsolvable problem. A big thing for me with the restaurant and anything that I do really is I will work myself to the bone. I will carry as much stress as necessary as long as I'm learning. But as soon as I stop learning, all the other stuff becomes not worth it. And that happened to me with the restaurants. It happened to me with the real estate stuff. And I'm not saying it's never going to happen with the markets, but one of the characteristics I like about the market is like you don't figure it out. You can always be learning. And even you've gone from an event trader to now you've opened up this whole new can of worms on the positioning side of things. And you're learning this entire new skill and realm in markets that after 15, 20 years of doing what you've been doing, you're trying something new. And I don't know all the details of the career, but you're doing that within the same marketplace, and that's so cool to me. And yeah, the vol stuff was a big part of the first phase of my career. It's been trading. It still is a big part, but now there's this whole other kind of more systematic futures trading realm. And then there's the newsletter writing, and then there's doing this podcast or recording. It's there's all these different layers that the market keeps feeding, and I love that about it. And getting back to the volatility stuff, kind of your original question, I think another reason why I was drawn to the market or to volatility markets was I have a kind of perpetual underlying sense of insecurity that's always kind of hanging over my shoulder. And it's in everything I do, not just the market stuff. And I think what I learned early on was if I can get some grasp on the volatility market and I can learn to read the tea leaves and pick up on the subtle signals and hear the whispers, maybe I can avoid ruin if I'm going to be playing in this market, as part of my career. And so that interest was born out of, I think, a sense of insecurity and just wanting to find, I just happened to be luckily introduced to volatility markets early on in this part of my professional journey and figured out pretty quickly, the volatility markets are really smart. And they tend to kind of know things before other parts of the market does. And, I know it's kind of a common adage that, the bond market knows first and it knows best. And it might, I don't know, I'm not a bond trader. But I'm pretty damn sure the volatility markets actually know first, and they actually can give you pretty early signals of what's good and what's bad. And generally speaking, they can really deliver and paint a very clear picture of how healthy the equity market is at any given time. And that's something that's happening right now. Right now, there's a big wall of worry. There's a lot of fear in the market. We're at all-time highs. We're worried that, that we're being set up for a big rug pull. And that could happen, I don't know. But when I look at the volatility market, when I look at the mechanics of the equity market, volatility market's saying everything's fine. And so I put my faith in that as opposed to, like you say, the entertainers out there who are trying to, invoke fear and get people scared. And, when I see the volatility market set up the way it is right now, it's saying there's nothing, I don't say there's nothing to worry about, but the market's fine, the market's healthy. And if we do hit some bumps in the road, there's some real resilience and cushion built in there that it will be able to handle it at least for a while. It's going to take a lot to tip this market over right now, at least from what the volatility market's telling us.
Yeah, well said. A friend of mine who's a longtime trader also, he says stay curious, right? And realize that you can never master this, right? You have to stay curious and evolve and keep learning. And when you hit that point, then that's the time to pack it in. I don't know how you could ever feel like you're not learning trading the markets, but maybe that's more of a burnout than anything else. But so that's a perfect setup for where I wanted to go next. So without giving away any secrets, can you walk us through a typical or a recent setup on a specific instrument and just sort of tell us how you alluded to how something crosses your screener, but I'm curious how you actually implement the trade. Is it in phases? Do you scale in? Is there some discretion? How do you size? All that good stuff.
Yeah, sure. So, I have my daily and my weekly routines. The daily routine starts with just a basic look at what's going on in the volatility markets. I always start there, even though volatility markets don't directly impact my other trading systems per se. I'm always just starting there. And so I have my different spreadsheets and tools that I put data into that kind of tell me how the volatility market's trading in any given time. I then, my systems are basically applied to, I don't know, it's 40 or 50 different major futures markets. And I actually should probably start on a weekly basis. Over the weekends when I do a lot of my work, I'm looking at weekly charts. All my systems start on the weekly chart. And so I scroll through all the charts of the futures markets that I trade on the weekly time frame, and I'm looking to see if any of these markets are within a technical setup that applies to one of my systems. So whether it's a range trade, breakout trade, trend trade, or compression expansion trade. And so once I start at the weekly, when I identify the charts that technically look good, I then dig into positioning. And this is where our systems to some degree kind of overlap, because I think as traders, we're all, any additional, I'm not say edge, I'm just saying informational input that we have that can accentuate or improve our systems is something we should take advantage of. And that was one of the limitations on trading stock compared to at least futures. At least with futures, there is data that can tell us what the positioning looks like. And as you well know, like, the positioning isn't perfect. It's not predictive, but at least it can kind of be another input into what I'm seeing on the chart. And so if I see positioning lining up with a technical setup in one of my systems, and I have different kind of metrics and barometers of what the positioning needs to look like when applied to each of the individual systems. But if I see those things start to overlap, then I'll dig in and see what my actual trade setup would look like. So most of my three primary trading systems, so the range, the breakout, and the trend, are all based on the weekly chart. And that just forces me to be really patient. One of the things I learned very early on with myself is one of my edges is that I'm very patient. And so zooming out to the weekly chart, making all my decisions based on the weekly action in those three systems, I feel like gives me an advantage. So when I'm looking for, once I see a setup, then I need to get confirmation price action candles on the weekly chart. And so I know going into Monday which markets are set up for which of my systems. I know what my entry is going to be. I know what my exit's going to be. Those are all predetermined by the system, so there's no real discretion on the entry price and the exit price. On my range and my breakout systems, I have price targets. On my trend and my COMEX systems, I do not have price targets, and we can get into exits later on, because that's one of the most difficult parts of all this is. And so I go into Monday morning knowing what markets I'm going to be trading in those on the weekly setup. And then what I do every day is I start the day by going through my active, what I have is actively set up markets. I'm also obviously watching closely the trades that I have on, but really the way I've figured out my system is, or my trading day really is, I'm on the West Coast, so the market opens at 6:30. I'm at my desk by 6 or 6:30. My daughter, she's 3.5. She's usually waking up by 7. What I like to do is by 7:30, I want to spend at least an hour or so plugged into the markets. That's when I write my initial post on Twitter every day. I share it then on Substack and Discord with your group. By 7:30, I want to be unplugging from the market. I need to step away. I spend an hour and a half in the morning. I step away, bring my daughter to preschool, go run some errands. I come back. It's 9:30, maybe 10, depending on how much other stuff I have to do away from the markets. I plug back in for another hour or so. Maybe that's when I'll do some writing. I'll update other things related to my newsletter or whatnot. I unplug again for another hour or two, and then I plug in one last time for the last hour of the market, and I watch it kind of somewhat loosely right up until the close. I update all of my spreadsheets. I come back an hour later. I do my final end of the day stuff, which my final end of the day stuff is I zoom into the daily charts for all of my setups and for all of the Actually, it's not just my setups. At the end of the day, I look at all of the 40 or 50 futures markets again on the daily setups, on the daily chart, because I'm just looking to see if anything has developed that is intriguing to me. Because my COMEX system, I will trade on a daily time frame, and I use that system on the daily and the weekly. On the daily time frame, I use it to potentially give me early entries into other setups in that same market. So if I see a breakout on the weekly chart setting up in, let's say, Bitcoin, when I zoom into the daily on like a breakout setup in Bitcoin, if I get a COMEX system long before the actual breakout long triggers, I may take that COMEX to get me in a little bit earlier, and then I'll add the second leg when the actual breakout system trade is triggered. So that's usually how I do it. I'm pretty systematic about my how much risk I put on with each trade. If it's on a daily setup, I'm usually risking 50 to 100 basis points. On the weeklies, I'm usually risking 100 to 150 basis points. I don't have any issue adding to trades, especially on the breakout or the trend systems. The range trades, they usually don't last quite long enough to do it. But, like I was saying, I'll get in early with a COMEX system on a breakout trade. I'll then add on the breakout. And if I get another system while the breakout trade is moving towards the price target, if I get another COMEX system trade setup go, I'll add that again. And along the way, I'll move stops up as I need to and try to keep my risk controlled. But yeah, that's something I continue to work through. When I first developed my systems, I did not add to trade. But as I've developed the COMEX system, it's been a good way for me to find additional entries and also additional exits or early signals to get out. So I've kind of learned to layer this COMEX system into my other systems to help supplement the bigger picture weekly signal.
And everyone should listen to that, what you just said, like understanding an edge that you have based on, I don't know, your personality, your history. And from that, patience and being very thoughtful is just huge. Imagine trying to go from a 2 to 4 minute holding period to now trading macro.
Right. Exactly.
So sticking with that theme, you mentioned that you use vol to tell you if you need to take risk off. So let's just talk about how many positions that you'll typically have on at once. And if there are multiple, how you think about correlations. And just to frame that a little bit, the OPI, the Offsides Positioning Index that I created, is really just a blind index with vol-based sizing, and there's no stops. So it doesn't cap exposure like we're probably doing in our discretionary systems. But how do you stay out of trouble without getting too offsides risk on or off, or US dollar or commodity exposure vis-a-vis looking at the volatility?
Yeah, and that's certainly a tough spot because I think you'll attest to oftentimes markets that are maybe positioned is the wrong word. Let's just look at the currencies. I mean, the currency position has been so offsides for so long. I am 0 for 5 on my most recent long dollar trades, either directly being long dollar or trying to short something else. The position has been glaring like something's going to change.
Yep.
And so I'll be getting, legitimate setups in the Swiss franc, in the yen, in the CAD, and they all look really good. And it's like, what I do in that situation, I just limit myself to one setup. Now, at a time, anyways. I currently lost money on the yen, on the Swiss, on the Dixie directly, on, a couple others trying to get this long dollar trade on. But I generally will try to limit it to just one position. If I have 3 setups and they're literally like about as close to being the same setup as possible, I just try to pick what I think is the best one, knowing that I'm probably going to be wrong. Now, right now, when I look at my portfolio, and you were kind of asking kind of quantity, I try to max out having no more than 8 positions on at a time, because I know psychologically once I get to 8, it just becomes hard to manage. And I also know that once I get to 8, there's a very good chance that there's some pretty highly correlated positions in there, even if I don't know it. And even though we all well know that correlations change a lot, and that's actually something I'm constantly looking at, is correlations between certain things. And correlations and changes in correlations are big parts of like my analysis in the volatility world and also outside of it. I really, the sweet spot for me is I find if I have kind of 4 to 6 positions on, there's usually enough diversification in there that, if one thing's screaming up, another position is kind of flattened down. I do not approach my trading with some sort of portfolio theory where I want to have X amount of exposure to this and X amount of exposure to that. I let the positioning and the technicals tell me when those things, when markets are set up, and then I just trade them. It's great when I have multiple positions on that do kind of, in theory, hedge each other or offset each other. That makes me maybe sleep a little bit better. But I don't do it intentionally. I don't do it where, if I'm long gold, then I also have to have on a position that, basically is the other side of that. If that position is set up, then I'll certainly put it on. But like right now, kind of going back to the original question, like I've got a lot of kind of quote unquote risk on trades on. I'm long the S&Ps. I'm long the NASDAQ. I just got, long Bitcoin on the breakout. I mean, you could argue those are all kind of the same trade. Bitcoin's maybe a little bit of an outlier, but they're basically all just risk on trades. And so I look at my book and go, yeah, that's pretty concentrated. I'm not maxed out on each of those position sizes, but I'm not 1/3 on each of those. I'm probably, 50 to 75% position size on each of them. So I've got overexposure there. So this is a period of time where I am absolutely watching the VIX complex, the vol complex like a hawk. And if I were to get a signal from the vol complex that volatility is about to go on a run, or the market health is deteriorating, or the volatility complex is getting more vulnerable to a big swing, I'll have to make the decision. Do I close out all or part of the existing risk on positions, and or do I put on a long volatility trade that I think and size it appropriately as best as I can to offset what I anticipate will be losses on the long risk on position. So it's certainly not a perfect science. Like I was saying, I don't apply some portfolio theory to my portfolio. It's more like what the market is telling me I should be in. And then when I do see that there's overlap like there is right now, then I'm looking for signals to either take down exposure or put on a hedge. And there's other times where the vol market may be telling me that yes, you can get long risk on here, but do it in reduced size because the VIX futures board is starting to flatten out or something like that, where I'm seeing some signals that things may be good now, but conditions are changing or deteriorating a little bit.
So it's a game time decision. It's not like you typically will always cut everything in half or take everything off.
Right.
Okay.
Yeah, it really depends on what I'm seeing. And, if, let's just say I only had long S&Ps on and I started to see the volatility complex start to flash some warning signs, I would probably in that instance just get long volatility if I got a go signal on a long volatility setup.
Right.
And I would keep the S&Ps on. I might raise my stop or something like that. But with 3 risk on positions sitting in my book right now, I'll probably be a little bit more aggressive with trimming whichever is the weakest out of those if things do start to get shaky, while also adding on a long volatility position.
Yeah, that makes sense. So you're not going to triple up to do covering your risk on because like we talked about before, the vols break or the correlations break down and you get ripped maybe both ways. So on that note, let's pivot into exits. We talked about that a second ago. I did a monologue on exits in a recent podcast, and they've always been my kryptonite, whether it's an event-driven or macro. And I've developed the Offsides Positioning Index. It's sort of like my North Star to really understand if positioning is on the right tail or the left tail of the bell curve. And it helps me sort of frame the window that we're in, where I can expect basically to have an average position to run or upper quartile, etc. So it's sort of like a living, breathing model that's really helped the discretionary system. So exiting losers should be reasonably straightforward. But yeah, let's dive into how you actually exit winners.
Yeah, I mean, in some ways it's like I'm grateful that half of my systems have price target, and I'm also grateful that 2 of my systems don't have price targets, although I sometimes wish they did, because it just makes it so much easier. But then it's like, the first 2 systems I developed are my range system, where I'm picking up trades at, I'm shorting at the top of the range and getting long at the bottom of the range and exiting, I'm exiting along before it gets to the top of the range. I'm exiting shorts before it gets to the bottom. Anyways, and then I have my breakout system. And I remember this going back a couple of years ago when I first started getting long gold on my breakout system. It hit my price target. And I was like, oh, this is great. I'm out. And then gold just kept going up. And it was like, oh, shit. Like, the next time I'm going to get a range, it's going to take months or years for me to get another range set up in gold or a breakout set up in gold. I should probably develop a trend system so that I can keep riding a breakout that continues to work. And that was great, except for there wasn't like this really obvious way to have an exit on a trend system that was purely technical. My other exit systems, price target systems on the other system, my price targets on the other systems, it is purely technical. And so there's liberation in the freedom to just let something run in my trend system or let something run in my COMEX system. But it's really hard to know when to exit even when things are going well. So the way I do it is with discretion, and the way I've come to think about it is also kind of related to volatility in that I keep a monitor on the daily ATR and the weekly ATR. There is also a price regime kind of indicator called SQN. I can't even remember what it stands for, but I picked it up from someone along the way. There's a group called Macro Ops, a guy named Alex Barrow, and then Chris Dover. and then Brandon Balo. They're the macro ops guys. Alex is the main guy, and I was part of their service for a little bit. They're awesome guys, just awesome guys, and I learned so much from them. But they use this SQA kind of regime indicator that's purely price action based, but it basically has 5 different regimes: neutral, bull quiet, bull volatile, bear quiet, and bear volatile. And so what I do with my systems that don't have price targets is I'm looking at the average true range, and I'm looking at this price regime indicator. And so if I'm long a market and volatility starts going up as the price is going up, and we move from a neutral regime to a bull quiet regime into a bull volatile regime, and I'm seeing the up moves start to really pick up pace, that's where I'll start to raise my stop and get more defensive. And for me, that's been the best way to layer on some technical component that's not price specific, but that has some discretionary layer to it as well. And my exits generally when applying those things, I at least can know that I'm getting out when things are starting to kind of destabilize to the upside. I almost think about it like, a rocket ship that's like going through the atmosphere starts to like shake, and like I'm just looking for like the loose bolts to start popping off things. Like you're still going up, it's still like going in the right direction, but shit's starting to shake a little bit here. And when that's happening to me, it's like, okay, I had a good run. We've moved into a price pattern regime where things are starting to really accelerate to the upside. I don't need to try to squeeze out every penny here. So that's really how I tend to use it. On the COMEX system, it's somewhat similar. It's really just looking at when does the volatility to the upside really start to take root and things start to move like really hot and fast. And that whole system is looking at price relative to the Bollinger Bands. And so, I'm looking for price to be breaking out above the Bollinger Bands on a long at the beginning. I'm looking for price to be breaking down below the lower Bollinger Band on a short. But then if I zoom out to the weekly, and that starts to happen as well, where price is above the upper Bollinger Band or below the lower Bollinger Band on a short, and it's happening as volatility is increasing and we're moving into, a bull volatile or a bear volatile regime, again, that starts to tell me that, okay, we might be getting out over our skis here. So, yeah, that's kind of my exit system. It's not perfect. I don't think there are perfect exit systems, but they're kind of built on top of the components of the systems themselves. And so if I'm entering positions when we're going from a compressed low volatility time, and I want to catch the beginning of the expansion into the higher volatility time, I'm going to ride that until the high volatility is starting to become destabilizing. That's probably the best way to say it.
It's a good answer because, let your winners run and cut your losses short and all this other stuff is such bullshit. It's like, how do you do it? And to have like somewhat of a systematic but discretionary way to do it. I don't know. If I didn't have something like that or price targets, I'm just going to do the wrong thing. It feels like all the time. So let's pivot for a second and talk about back tests and what like the bell curve performance and windows and all that stuff. I have pretty strong opinions on concepts like back testing, but what are your thoughts on back testing? And did you go down that route when you first started?
Yeah, it's a great question. And I think my opinion is similar to yours in that back testing has a lot of flaws. And I know a lot of systems are built around back tests. I'm sure those systems perform way better than my systems. It's just not something that I've had, I don't say the interest in. I certainly, don't have the computing power to do, something truly robust. But that said, as I was developing my first 2 systems, the range trade system and the breakout system, I did do a manual back test. And I found that and by that I mean, I took these 40 or 50 futures markets that I trade. I went back, I think 20 years for each of these markets. And at the outset, I literally wrote out what the parameters of each of the trading systems was, like what do entries look like, what does positioning have to look like for each, what are the exits, what are the, I can't remember, whatever the 10 or 15 qualifiers were for entries and for exits for each of these systems. So I knew exactly when I would enter on this and when I would exit on this back test. And so I went back and did this for the 40 or 50 market for 15 or 20 years. And it took forever. I went tick, and I was doing it on the weekly charts. And so I use Thinkorswim as my trading platform. And you can go back and just do it tick by tick. So I wasn't looking ahead. So I was doing my best not to look ahead. So I didn't know what was actually going to happen. Again, this is imperfect, but I did my best to be honest with myself. And I just kept all the stats. And now the stats were good. Like the stats spit out really good data. It was like, man, these are real systems. These actually really work. I don't have all the stats in front of me, but it was compelling to say, hey, there's something really here. This is something, these are systems that you should at least pursue for the next, foreseeable future, and see if the stats in real time line up with the stats from the back test. So the stats were good. Do I have 100% faith in them? Absolutely not. Absolutely not. But what I will say is that the process of going through 50 different markets over 15 or 20 years, tick by tick by tick, and they were weekly ticks, so it wasn't, but this took me months to do because I was doing this on the side that will also keep me up with my regular trade. The process alone taught me so much about these trading systems. And the rules did evolve over time, so I'd have to go back because I was found a new rule that I think, I'd seen it anecdotally enough times in a market that I would go back and go, okay, well, I should actually tweak the rule a little bit this time, and I'll go back and do it again. And so, it was all these iterations taught me so much about the systems that then gave me more confidence in the systems themselves. So even if I didn't believe as much in the data, even though the data was getting improved over time just by me kind of to some degree fitting what I was learning along the way, the actual rules got more nuanced and more clearly defined. And that's what gave me the faith, was that I've now gone through so much data for each of these markets. And I kept notes for each of the markets. So I know that I'm going to make this up. I know that soybean meal is a shitty breakout system market. I'm not actually saying it, but for example. And so I have those notes for me. So when I'm going to trade soybean meal, if I know from my notes on the back test that it tends to fail halfway to my price target on breakout trade, then I'll take the trade still, but maybe I'll trim it halfway to the price target because the back test showed me, and I still can go back and look at all those charts and all my notes, and I can see it, yeah, that was okay. So anyway, that's where I see the value in the back testing. And that's where it's like when you're running just a purely data back test where you dump in all the parameters and you have some, computer system run the back test for me. I think that's where you kind of might lose some of the value because what the parameters are, but you're throwing them into this box that just spits out the data, and you didn't have to do anything truly manual to go through it. Maybe this is me just sounding like a dinosaur, but there really was a lot of value just going tick by tick by tick, and getting excited at one point because it looks like these systems are crushing it, and then I get to the next market and the system works terribly on that market. You know what I mean? But that process just taught me so much. So, that's my that's my rant on backtest.
That's probably one of the most important things you said in the whole call. It's that process that helps it absorb into your skin, right? And I think, we can get on the topic. I don't know if you've gone through the whole machine learning rabbit hole. But I think that's going to be part of the problem with machine learning is, I know you don't just throw a big spreadsheet of data into the machine learning. You have to massage it and kind of do a back test. But I think the output to that, I know it's not totally black box, but when that system starts to break, you don't know how to explain why it's going to break. And if you do it, I don't know, old school, like you're doing it, or some complicated Excel thing, you don't really, you can't solve the puzzle, but you can kind of get a better idea of where it's failing. And I think, it sounds like you're doing a lot of this stuff in the background. For me, that's the OPI. Right. I'm still trying to stick to my process and put on a bunch of trades, but there's just been a lot of dog shit lately. And if I was putting that information into a black box or machine learning, I'd be like, I don't know why it's breaking. Right? If a capital allocator calls you up and it's like, why are you having a X% drawdown? At least you could say, look, well, I'm looking at the vol regimes and breakouts are just in a phase where they're not working. They're on the left tail of the bell curve or whatever. And I think doing what you're doing, or the OPI, is like our North Star, so to speak. So, all my experience trading and just being in front of the screens for way too long tells me that any system that's scalable, and I think that's an important nuance here, as long as it stays largely unchanged, we'll have what I call windows, right? A period of time when it will work and a period of time when it won't work, or maybe a period of trending water. Now, I think right away, I think about trend following systems. And I do like that strategy, right? If you look at the stats, it's got good Sharpe ratio and all this other stuff. But I don't know how much those guys are really changing up their systems over time, because by definition, they're not supposed to be very discretionary. But what's your view on that concept of windows?
Yeah, I mean, I saw it in the process of doing my back test, where certain years there was a lot of range trades, and certain years there were more breakout trades. There was times when the range trades weren't working and the breakout trades were, and vice versa. And I've even seen it just in the past 2 years. Like last year, I had way more range trades than I had breakout trades, and the breakout setups that I did have, a lot of them were failing. This year I've had near zero range trades, but I've had way more breakout and trend trades. Now, for context, I am not a high frequency trader, so the number of trades I'm talking about here is still relatively small. But if last year I had 20 range trades and 4 breakout trades, this year it's like I've had 3 range trades so far and 6 breakout trades. So this is part of the reason why, because markets are either going up, they're going down, or they're going sideways, generally speaking, right? And that's kind of why I was drawn to developing a few different systems. The range trade is my sideways system. The breakout trade can be long or short when markets are going up or down. My trend system can be long or short. It's just catching a different part of it. And the COMEX system can work within the range, or it can work during a breakout, or it can work during a trend. So I've kind of found these systems to kind of cover me, quote unquote, during kind of these different windows, as you refer to them. And it's certainly not perfect, but in the back test, in the 3 years that I've been running these systems, it has absolutely been true. And it's interesting that's happening within market classes. So, the currencies have been in kind of breakout mode this year, whereas for years they were like great range trades. And then this year, all of a sudden, they're great breakout trades. And then, the energies are a little bit different, but, and then the equities, have obviously just been a, be long and forget about it trade. But so, yeah, you'll see it within market classes. And then you'll see it, within specific markets as well, where a market will just be stuck in the range for a really long time, like platinum or palladium. Like those have just been sitting there, dead water at the bottom of the trough for years, and now all of a sudden they're breaking. So you could have been trading these ranges for years, and now you're going to finally trade them on the breakout side. So, my systems will definitely have their windows, and trying to be that was also part of the benefit of doing the back test, is I really got familiar with looking for the characteristic signs of when the range system is running out of steam and likely to move over into the breakout system. Or when I'm trading the range system and it looks like it's going to break out, I have a pretty good feel for when I think it's premature. Like, oh, this is going to be a false breakout because the range just hasn't been setting up long enough. And that's been confirmed just by trading these systems live for the past 3 years. So the Windows thing is absolutely something that I've noticed in real trading and in the back testing.
So let's get away from our systems for a moment. I'm always trying to figure out not only where positioning is offsides, but what everyone is either talking about or not talking about. Are there any topics right now that you think no one's talking about? And it could be a particular market that we trade. It could be something outside of trading, like real estate, whatever. Is there anything on your radar?
God, I have really deliberately tried to cut out as much input as I possibly can. I don't watch the news. I don't listen to the radio. I have, I hate this word, but curated my podcast listen to list down to like just a handful of folks, a handful of different podcasts, most of which are not market related, or some of which, so I really don't have a great feel. Well, it's not like I really don't have a great feel, but most of my feel for what's going on in the market is going to be tied to like general, index equity indices and the kind of big high level, the headlines that kind of everyone gets to see. So whether it's what's going on with inflation or the jobs market or the Fed, like I pick up on that stuff. I'm not seeking it out, but I do keep an eye on it. So yeah, there's not a lot that like right now is that I'm picking up on that like I don't think other people are aware of. What about you? What are you seeing and hearing? Maybe you'll jog my memory or inspire me to.
You know what? A friend of mine is really good at taking in loads of information, and he's able to like compartmentalize. I can't do that. I mean, if I have a position in something and I hear some compelling argument to get out of it, I probably won't because it's very systematic, but I can't handle that. So I'm like you, I really turn everything off. In fact, I turned off CNBC about a dozen years ago. People think I'm joking when I say this. I think it's probably one of the best things I've ever done for my trading career. But in general, no. I mean, I think there's going to be a lot more discussion on, I mean, it's everywhere now, but I think there's going to be a lot more discussion on machine learning. And I only hear everyone just talking about how great it is. So I think maybe that's a little FOMO right now. I even hear that from some of the capital allocators that I talk to. They want to see that word or those words in your pitch deck. But other than that, no, not much is on the radar.
I mean, I guess one thing that's kind of poked up a little bit is like, and I don't trade this in my systems, but it's more like what I do with my retirement accounts. But I feel like biotech is starting to wake up a little bit here. And, you know, it's been hated for so long. And then there was a lot of excitement around RFK Jr., but then that died out. But kind of quietly in the background, you know, XBI and, you know, some of the other ETFs and even individual names are like starting to pop up a little bit. And then, you know, all it takes is, you know, you give biotech a little injection of AI fever and, you know, and it could really start to run. So I don't know, that's one area that I'm not seeing or hearing many people talk about, but could possibly is starting to show early signs of getting moving. But you know, those are the types of things that are like I do have, like, you know, full discretion. I do have like a long position in my retirement accounts in that. I think it's XBI. But I just see that as like outside of like what I do day to day, you know, like, yes, I manage our retirement money, and yes, there's kind of, I do apply like my different systems to the markets that I trade in those accounts, but it's not the same in like my day-to-day trading, which is, I kind of feel like more of what you're asking about. Yeah, all the fun, like really extreme narrative that were around, you know, going into the election, coming out of the election, there was just really, it just seemed like it was so obvious what everyone was thinking and so one-sided that it was almost kind of easier to be contrarian and also to have like, you know, listening for whispers that the market was saying like, yeah, all those people are wrong. Now it's just, it almost just feels like it's gotten so noisy and just so, you know, over the top. I think if there's maybe one thing, it's like, and we can talk kind of specifics. Like I'm now 2 legs into the long copper trade, and you know, I had no idea that Trump was going to, you know, put a 50% tariff on copper, and it's great that my P&L is, you know, benefiting from him doing that, but I hate the fact that my P&L is benefiting from a tariff headline. But it is starting to kind of smell a little bit like maybe, because there's been plenty of people on Twitter and various discords I've seen jumping in saying, I'm shorting copper here because you know, Trump always chickens out, and it's like, well, I know this isn't like an original thought, but like, what if he doesn't chicken out this time? Like, what if now that he's passed the big beautiful bill, he actually goes like harder on tariffs? Like, he got what he wanted in the bill, and now it's like, screw it, now I'm going to go hardline on the tariffs because I feel more comfortable in what's going on domestically in the U.S. because I got what I wanted. And you know, and I'm talking my book here, but like, if people are applying the old taco trade to copper, and the market's about to inflict some pain, it would be that the taco trade doesn't work anymore and copper is going for a ride, you know? So maybe that's one kind of theme.
Yeah, you know, I'm with you on that. You know, my brother and I talked about that a few podcasts ago, where Trump maybe feels like he's got a lot more room now, so to speak, right? Because the market's at all-time highs, right? And you know, he can come out and talk shit about tariffs or whatever, and the market just doesn't really seem to care anymore. So, and the bond market's not really reacting either. So maybe he feels emboldened to do that. So, Tony, before we wrap up, I just want to say that any interaction that you and I have had online, I can tell you're really thoughtful about your process and your system. Hit us with some veteran advice. Any advice for people that are either in the business a long time, maybe they're struggling with their systems, where they realize they need to like stay curious, like we talked about before, and branch out. Obviously, you showed us that having 2 or 3 different strategies is very beneficial because of that window concept. Or even a new trader in the game less than a couple of years. Do you have any words of wisdom?
Yeah, God, I think applying veteran to me is probably not fair. I've really only been full-time in this for 6 or 7 years, ultra curious for probably 10 years. Yeah, I mean, I would say that like an important part of this is developing a real sensitivity and awareness of the signals that you get from yourself. And what I mean by that is at the outset, there are a lot of shiny objects. If you go on X or any platform, you go on YouTube or anything, you're constantly going to be sold by people telling you that they have found the Holy Grail system. And I think it's probably just part of the process that you sign up for some of these services and you can absolutely learn from some of these folks. But what I think is the most important part about it is you're not trying to learn. I hate saying should, but I think there's more benefit to go into those engagements. And I pay for a couple data services, so it's not like I'm immune to this. That's how we met, was through Jason's CMR.
Yep.
And so, but I think it's like if you go into those types of services or any of these pursuits, whether it's just reading books or watching videos or actually paying people for, trade subs and whatnot, it's going into it thinking, what can I learn about what they do that I can bring back home to myself and see if it fits with me. And what I can tell you is that that takes a really long time of just getting a lot of exposure. But this has been repeated 1,000 times. There's no secret out there. There's no book you're going to read. There's no service you're going to pay for. There's no video you're going to watch that on its own is going to lead to some revelatory moment. But there's a collection. There's this building up over time of exposure to all these different, literally time frames. I remember having an aha moment laying on my couch back when I was in DC when I looked at a weekly chart and immediately my anxiety went down. And I was like, oh, I like weekly charts. They just fit with my personality better. I don't like intraday charts. I watch intraday charts on the VIX stuff. I track data intraday on the VIX stuff, but that's it. And then I'll zoom into the daily for my comic system. But it was that one moment of just realizing, oh, weekly charts fit better for me. So that was a breadcrumb. And then there's just so many of those things out there. So if you go into the learning environment, I think about it as what can I potentially learn here that I can bring home that fits with me and feels natural. And that's where, and after you do that for long enough, it may start feeling like you're having more aha moments, but I would argue it's that you've just collected a lot more of these little breadcrumbs. And so then when you do see something or you do explore something and you do have an aha moment, it's because all these small little things have built up. And so that's it sounds really simple, but as I was exploring, this is probably 5 years ago, and at that point I was years into the volatility trading and creating all these systems around that. And then I had this one experience where I was looking at charts and looking at someone else's system, so another trader who I really respected, who I'd gotten to know at that macro ops group, and he was showing me a system he was developing, and something about it just landed. And it was just oh, that's me. That fits with me. I like that. That just feels comfortable. That feels natural. And I had probably seen a general setup like that hundreds of times before, but it had taken years of finding all those other breadcrumbs and, picking up all the little pieces along the way. When I saw that last time, it all made sense. And then there's oh, I can build a system around this.
Right.
Because I can apply this to a weekly chart. I can apply this. And then when I learned about Jason's stuff and all the positioning, I had always heard about positioning and flows and all this. I was I don't know how am I ever going to access that? And then I hear Jason on the podcast talking about positioning. It's oh, aha, I'm going to go see what he's up to.
Yeah.
And once I dug into that, then it was oh, I can apply my systems, which I had developed, the range and the breakout system. I can apply that to futures. And now I have another whole level of data with the positioning that I can apply to my technical setups. And then holy shit, as I was doing the back test, it turned out that the positioning really had an impact on the outcome of those trade setups. It was now I'd heard about positioning for years, but at some point, once I developed the basics for my trading systems and I learned about positioning, it was like another aha moment. I can bring that home and I can apply that to the systems that I've already been developing to give me just a little bit more of an edge. And so that was a very long-winded answer, but
no, it's a great one. You had to go through that journey to figure out where the key fit into the lock, right? And you've seen,
exactly.
You saw all those weekly charts subconsciously for so long, but it was that one moment. But you're never, I don't think anybody would ever find that moment, within the first year of trading. You have to go down that path. You just,
Right.
I'm sure you're like me, where you have so many people that they say these exact words. They say, "Can you show me how to trade?" And you're like, "Oh man." like like, how do you even articulate that? But I've had some people come. I'm like, why don't you just come to my office and sit behind me, and I'll show you how I trade. But I'm like, one out of there's a million ways to trade, right? Like, nobody's trading exactly like you. Nobody's trading exactly like me. Nobody's trading exactly like Paul Tudor Jones or whatever. It always circles back to psychology and personality, right? I think we've said that word so many times. So, Tony, you trade your own capital like me. So what's the plan? Do you just want to compound over time, or do you have bigger aspirations to go raise capital or go to a large shop that gives you capital? Like, what are you thinking if you had to think a few years out?
Yeah, I think about that a lot. And part of, as trading is like such a lonely endeavor. Like we just spend so much time by ourselves. When you're an independent trader, you just spend so much time by yourselves in your own head. That's part of the reason why, it's been nice to join like your Discord and be a part of, I'm still a part of Jason's group. I'm not in there that much anymore, but still just to like feel like, yeah, there's other people in here kind of mucking it up, trying to find their way in this world. And so and I'm a very collaborative person. I do like working with other people and being creative and exploring things and doing that as a team and whatnot, even though I don't really want employees. And so I've entertained the idea of like, what would that look like if I did, and my aspirations are very, modest. Like, I would never, if I was even to consider doing that, this is not like hundreds of millions that I'd be aiming to try to manage. But I do think about like, what would that look like if I raised a chunk from friends and family? I think I'd probably have a long enough, track record professionally, even outside of trading, just through my career as a restaurant owner and whatnot, where I think people trust me generally. And part of the, the motivation for starting to share more publicly in the newsletter was just because I have no idea where it could lead. And frankly, like, I wouldn't be talking to you right now if I didn't start, putting myself out there more. And so even though I'm not actively looking to do any of that, putting myself out there opens up those potential opportunities if something compelling were to present itself. That said, I know it would be a lot more complicated than I appreciate. And I always now, I've learned the hard way that like anytime I'm feeling an impulse towards something, because I think there's an opportunity just to make more money, I need to stop and look at that really closely, because an impulse just to try to make some more money will allow me to overlook many of the other things that I should be paying attention to. So, it would have to be a pretty compelling opportunity. And, whether it's the idea of raising a bunch of money and starting a fund, probably pretty low on my list right now, unless, I see it in a perfect world, unless like a small group of wealthy individuals pooled money, really understood what my systems are like, really were just like looking for the type of return stream that I could offer. And it was just like a small group, relatively small pile of cash. And they understood what the system would how it would function, like what the drawdowns would look like, what the return potential is, what the volatility looks like. And I just feel like the odds of that happening are like pretty low. Do I actually want to go and try to, find a pod shop that's like legitimate, that, give me access to more capital? Maybe. But then it's like, now I've got, kind of a boss again. And like, I've been self-employed since I was 27 and I'm 43 now. My wife has a medical practice that is, on the verge of, really taking off, and I help her on the back end. And I think that my room is going to be going down more. So it's like, to what degree would I extend or overextend myself, try to, line my account with whatever millions of dollars, so then I could just come back and keep trading by myself? Like, it would have to be a pretty sweet setup that didn't infringe upon all the other stuff I'm involved in. And that seems relatively unlikely, when the reality is, like, between, our businesses and our investments, like, and then compounding just the money I'm trading right now, do I get there anyways? It just takes a little bit longer and I get to avoid all those other potential headaches. Like, yeah, that actually sounds kind of good too. So, I don't know. I've never gone through the process of raising money. I've never gone and, managed money for somebody else. So, you would have, if someone approached and we could have a real serious conversation about it, it checked a lot of those boxes, then I would certainly consider it, but it's not something I'm actively pursuing.
Tony, it was a pleasure connecting. I'm really grateful for your time.
Yeah, man, this was great. I'm glad we finally did it, and love to do it again sometime.
Again, you can find Tony on Vixed Signals on X and Free Dominion on Substack. I'll link those both in the notes. Thank you again, brother.
All right, man. We'll talk soon.
Thank you for coming to Offsides Macro. The views expressed are my own and do not represent the views of any employer or affiliated institution. Nothing discussed should be considered financial advice. This content is for informational, educational, and entertainment purposes only.